Hi, good morning and welcome to Altair Advisers webinar. Today is Thursday, March 24th, and I'd like to bring you the Spring 2022 update. Today, we're going to be joined by our speakers, Jason Laurie, our Chief Investment Officer, as well as David Lin, our Head of Investment Research. And we have a guest speaker that's going to talk with David a little bit later on, Chad Cleaver with Driehaus Capital Management. I'm Bill Shannon, the Director of Strategic Growth. And some of you know us pretty well as a firm. Others of you, this may be the first time you're interacting with Altair. So let me just take a moment to explain a little bit about our firm. Altair Advisers, we provide wealth guidance for life. And what that means is we're a registered investment advisory firm, and we're really focused on providing financial advice for people for all areas of need. And we are not a sales organization. We are privately held and independent. We're broadly owned by employees. Our clients are primarily individuals and families and their related charitable entities. We act as a fiduciary, which means we are our best client, our service, our clients best first. And the three areas that we focus on are our financial planning, investment management, and client education. We'll talk a little bit about investment management today, but other areas that we work very closely on with clients are the other two that are mentioned here. If you think about how we interact with our clients, all of our clients have engagement teams and a primary engagement team. And then there's a whole host of people that are sort of the broader service team that are sort of literally behind the scenes working to make sure we have an excellent client experience. Today, we're going to hear from a couple of folks that are involved in the investment committee, as well as the research team. And with that, I'm going to turn it over to our Chief Investment Officer, Jason Laurie.
Thanks, Bill. As Bill said, my name is Jason Laurie, Chief Investment Officer here at Altair Advisers. I too want to welcome you to today's spring webinar. I'll begin with a short market and economic overview, and then I'll hand it over to my colleague, David Lin, Altair's Head of Investment Research, for a question and answer session with his guest, Chad Cleaver from Driehaus Capital Management. So with that, I will dive right into performance and do a quick check-in on where we are in the major asset classes. All the performance is as of Tuesday of this week, March 22nd. I'm sure it comes as no surprise to all those listening to this webinar that the year-to-date performance for all the asset classes are negative. The low light is large cap growth, although that's the most negative, with technology stocks down the most this year. The highlight is really the value side, large cap value, just barely negative for the year. And then finally, if you look at the bottom categories, the bond categories, both taxable bonds and municipal bonds, are negative for the year. This is because interest rates have been increasing. The 10-year Treasury yield started at 1.5 this year, and now it's around 2.3, 2.4. As interest rates increase, bond prices decrease. So uniformly, we can see that the major asset classes, unfortunately, have been negative for the year. And it's not just that the asset classes have been negative. It's that volatility this year is much, much higher than it's been in the last year, 2021. 2022 is much more volatile than 2021. I created a chart here of the S&P 500, but I could have created this chart for any of the major asset classes, and the same theme applies. These major swings that we're seeing this year. You can see on this chart in January, it only took us 8 days to lose 7%. And then the most recent week, we actually gained 7%. So huge swings. Our takeaway is that it's certainly a time in this volatility that you want to stay the course and you want to limit trading, because you could really get on the wrong side of this volatility in only a short period of time. Of course, the most common question we're receiving is on Russia's invasion of Ukraine, a theme that will run through this entire presentation. And of course, the most important aspects of this event are first and foremost the unfolding terrible human tragedy, and our thoughts are certainly with all those that are impacted. And the second is the general upsetting of the world order. That certainly will be long-lasting. However, on the financial side, for most US investors, the impact of the invasion has been limited, which actually is quite normal. And that's what we're demonstrating here in this screen, which is, if you look at the gray line, this is the 15 major military conflicts going all the way back to World War II. And what you can see is if you look at how the S&P 500 performs, initially after the conflict, it goes down. And then over a number of months, it pretty much is almost a non-issue for the stock market. And you can see that the orange line, Russia-Ukraine war, is kind of following the same pattern, but obviously far too soon to make any kind of long-term conclusions. So that's the stock market. But the invasion and war and geopolitical events can certainly impact other markets that have a much longer term time horizon. And that's what we're seeing with this invasion. Russia's share of world GDP is only about 1.7%, so not that big, not that impactful. But the issue is that they're the second largest producer of natural gas, the third largest producer of oil. So we're really seeing the energy sector and commodities more broadly being impacted by this invasion. And Chad Cleaver, our guest later in the session, is going to talk a little bit more about the other commodities. I'm just focusing on this chart on oil. And really what you can see is that ever since the invasion, the price of oil has pretty much been straight up. And as we sit here today, it's at roughly an 8-year high. How does this feed into the overall picture? Well, as pretty much everybody knows, that we were in a higher inflationary environment pre-invasion. And a lot of that was due to the pent-up demand from the pandemic, the supply chain issues that we're now all very well aware of. And this invasion, because of the impact on the commodities, both energy, metals, and really the entire commodity complex, what's going to happen is this high inflationary period is going to be prolonged. It's going to last longer than we would have otherwise thought. So inflation will still moderate, but it's going to take longer to moderate. And in fact, the next inflation reading we get, which is going to be released on April 12th, will no doubt be higher than the 7.9 reading that we got on the last, because that will start to impact some of these price increases after the invasion. So how is the Fed going to handle all this higher inflationary period? Well, they had their meeting last week, and as everybody pretty much guessed, that the Fed raised rates for the first time since the pandemic. They increased it by 25 basis points or 0.25%. So that wasn't new news to anybody. But what was new news is their projection for the total rate increases for 2022. In December, they told us they were going to raise them about 3 to 4 times. And now here in March, they told us they brought it all the way up to 7 times. So a huge swing. And in fact, if you go back 3 months from December and look at their September projection, they were forecasting 0 interest rate increases. So in a 6-month period, we've gone from 0 to 7. So you can see a huge shift in the Fed. They're signaling to the marketplace that they're serious about fighting this higher inflationary period. And Powell, Fed Chair Powell, is certainly in his press conference indicating that Russia's invasion of Ukraine will only elongate this cycle. That's why they're taking it far more seriously today than they were even 3 or especially 6 months ago. At this same meeting, the Fed released their projection of growth rates of the economy. Again, as we all anticipated, growth rates are coming down, but the bottom line is the growth rates are still very positive. And you can see from in 22, 23, and 24, we expect solid growth of the US economy. We also expect that in the non-US or the global economy. The managing director of the International Monetary Fund made a similar comment this week. That is that growth rates are certainly going to come down, but yet still be in positive territory. The second most common question we're getting after Russia's invasion of Ukraine is just the overall cycle that we're in. The Fed is going to increase rates. We're in a higher inflationary cycle. Gee, doesn't that derail markets? And actually, historically, it doesn't. On the screen here, what we've indicated is the last 75 years, every time we've been in a tightening cycle. And if you look at what happens to the S&P 500, 1 year, 2 year, 3 years from that initial tightening point, and that's kind of where we are now, Most cycles, the S&P 500, 1 year, 2 year, 3 years from now, do perfectly fine. In fact, most of them, it does really very well. There are a few exceptions. Why are there a few exceptions? Because the market is concerned about recessions. The market is less concerned about higher rates and the Fed increasing interest rates. It can happen that the recession and higher rates and the Fed increasing rates can happen together. That certainly could be the case. But the key is to be on recession watch. And we certainly do not believe that there is a near-term recession. And just like the Fed told us last week, they too don't believe there's a near-term recession. But that is the key, monitoring recessions. Why don't we think there's going to be a recession? Well, we have a strong economy. I have two checkpoints here. One is the labor market. We keep adding jobs at a very robust pace. And on the right-hand side, we talk about the job openings. We've been writing about this for the last year and a half, that the number of job openings are at a record level. Employers are indicating that if their biggest issue is they can't find labor. So that's very bullish. And in fact, we could even do a real-time check-in of labor this morning on Thursday. Here we got the weekly jobless claims, and they're now below 200,000. The lower the number, the better. That's very bullish. That's a 50-year low. Again, indicating that we still have a very strong labor market. Finally, the consumer. The consumer is very well positioned. Over the last 2 years, the consumer has been bolstering their savings, bolstering their balance sheets. The old adage is that when we have higher prices, when we have inflation, consumers stop spending. That certainly isn't the case right now. And it's probably not the case right now is because the consumers have the cash to spend. Won't last forever, but certainly consumers right now are willing to pay the higher prices. So in summary, before I hand it over to David, war, inflation, and the rate increases have certainly pressured all markets. As I mentioned, all the major asset classes are negative year to date. Commodities were already on the rise before the invasion, and now they've accelerated since the invasion. So what's going to happen? This higher inflationary period is going to be elongated. It's recessions that the market is the most concerned with, not necessarily higher inflation or not necessarily the Fed increasing rates. We've got to be on the lookout for recessions. We do not believe a recession is near term, but certainly something that we talk about in the investment committee all the time. Growth rates are slowing both here in the US and globally, but the economy still remains strong. It's positive growth. And then finally, this extreme volatility that we're seeing in the markets, we do not believe that's going to end anytime soon. And that's obviously because the near-term global outlook is still very clouded because of the Ukraine war is still in its early, unfortunately, still in its early days. So with that, I'm going to hand it over to my colleague, David Lin. David?
Thanks, Jason. It's great to be here, and thank you all for being with us today. As Jason mentioned, my name is David Lin, and I'm Altair's Head of Investment Research. First, I would like to echo Jason's comments that we at Altair are troubled by the war in Ukraine and the devastating impact on those involved in the crisis. Our aim today is to provide insights on the geopolitical and economic events that are causing a great deal of market volatility. So we wanted to bring in an expert, Chad Cleaver, who is an expert in international equity investing. Chad is the portfolio manager on Driehaus Capital Management's emerging markets team and the lead portfolio manager of their emerging markets growth fund, which is one of Altair's recommended strategies. So Chad, thanks for being with us today.
Thanks, David. It's my pleasure.
Let's jump right in. So Chad, in Jason's earlier slides, he addressed the impact the war is having on specifically global energy prices. But both Russia and Ukraine are significant importers or exporters, I should say, of other important commodities. Can you talk about a few of the bigger ones here that might be receiving a little bit less attention and their impact on global inflation and the supply chain?
Absolutely. First off, to provide some context, counter to the 1970s oil embargo, we haven't seen widespread sanctions or embargoes of various commodities, which has been a positive development thus far. Of course, the US and UK have sanctioned Russian oil. and Russia itself has taken measures to restrict exports of fertilizers. However, most of the activity beyond that has been more self-sanctioning out of concern for reputational risk. So we've really seen more of a repositioning of commodity flows rather than an outright disruption. However, a potential negative ramification if conditions were to worsen is that Russia's presence across commodity markets is much deeper than just oil. Russia is a major exporter of energy, metals, as well as agricultural commodities. And bearing that in mind, I think one area that could be of concern due to Russia's concentration is natural gas. And in fact, Russia supplies roughly 40% of Europe's natural gas. Of course, the immediate impact, if we were to see a supply curtailment, is concerns over the ability to heat your home during winter season. However, there are also second order impacts because natural gas is used as a fuel for things like aluminum smelters and an input into fertilizers. So the knock-on impact in terms of inflation to other commodities from any sort of shock to natural gas prices could be more acute. Secondly, an area where we are actually seeing supply disruptions is in the agricultural commodity space. Logistically, it is very difficult, if not impossible, to get a ship into Russia and Ukraine to be able to export these types of commodities. Furthermore, sadly, is one of the consequences of the war, the planting in Ukraine could be disrupted. And collectively, Russia and Ukraine supply about 30% of the world's wheat exports and are also major exporters of other grains. So the food inflation impacts that we see not only from the grains, but also from the restrictions around fertilizers are adding an extra impulse to food inflation. This has ramifications across both the developed and developing world. If you look at the calorie basket, so to speak, of the developing world, wheat comprises upwards of 30%. In many economies in the Middle East and North Africa, as well as Southeast Asia, are major importers of Ukrainian wheat. So this is coming at a time in which global commodity markets had already been tight. We're seeing disruptions across a number of areas due to energy or due to shifts in weather patterns, and this is just an added impulse to those.
Great, thank you for that insight. Let's focus a little bit on your specialty emerging markets. The last couple of years have been quite challenging for emerging market countries. They had a slow and uneven recovery from COVID, the Chinese regulatory crackdown on tech, and now you have the war. I know you're not allowed to discuss specific companies for compliance reasons, but what areas of the market are you avoiding today, and where are you finding opportunities?
As you mentioned, it's been quite turbulent times in China in particular. Last year's regulatory crackdown, as well as stress in the property market, and then an energy crunch in the second half of the year created material pressures on growth, in particular the equity markets. And our strategy had actually been significantly underweight China for the vast majority of last year. That being said, China is one economy that has been really out of sync with the rest of the world with respect to its growth patterns on the upside and the downside in the past couple of years since COVID first transpired. And we see probably the strongest efforts on the part of the policymakers in several years to stimulate the economy, to bring about more of a growth normalization as we move into the new year. So we expect increased emphasis on infrastructure investing, as well as kind of a structural focus on areas such as electric vehicles and renewable energy. And so at the margin, we've been reducing the magnitude of that overweight in China as we move into the new year. Conversely, India is an economy that we really like over the long term. We think it has probably the best growth fundamentals across emerging markets. It's also a relatively closed economy in terms of trade, and one that's reorienting its economy away from lower productivity areas and shifting into higher productivity areas that we think could be very positive for wage growth, consumption, and the overall economy. That being said, India is one of the most commodity sensitive countries in emerging markets from an import perspective. So it's a market that has had very strong performance, but could be increasingly vulnerable in the months ahead. So we've been reducing our weighting in India in recent months. From a sector perspective, energy security is a topic of conversation that we've been increasingly emphasizing in recent years. This entails both investments in service companies as well as renewable energy companies. You know, one of the features of the recent commodities shock and events in Russia is that major economies, most notably Europe, have doubled down on their efforts to bring about renewable energy capacity in the years ahead. So we think that bodes well for many of the companies in the supply chain, which are located in China. And then lastly, I think I would echo Jason's comments that it's been a very difficult time for tech in light of the prevailing macro conditions. But we also don't want to lose sight of the dramatic innovations that many of the companies in emerging markets are making in the technology sphere. So we remain very positive on some of the Taiwanese technology suppliers that are supplying next generation equipment that is really focused, broadly speaking, on the electrification of our day-to-day lives. So things like auto electronics, 5G, and the Internet of Things.
Great. And if I may ask a follow-up question to your comments, over the last few years, there's been this increase towards populism, and because of COVID and the war, there is an increase, or at least the thought of increase, of deglobalization. How do these two concepts impact your views?
Well, I could probably spend a full hour talking about these subjects, but I'll list one point on each of them separately. With populism, one thing that's gone hand in hand with that is a rise of resource nationalism, as well as higher tax rates and higher royalty rates. And we see this most starkly in Latin America, where Chile and Peru are two heavily concentrated producers of copper, collectively representing about 35% of global copper supply. And we've seen various types of disruptions and change in the regulatory regimes in these two economies. And emblematic of this is the fact that major producers have been unable to increase copper supply despite historically high prices. So this is one side effect, I think, of the wave of populism that we've seen around the world. Secondly, as it pertains to deglobalization, I want to focus on China here for a moment. We think it's going to be very difficult to supplant China as a manufacturing behemoth. China represents about 1/3 of global manufacturing value add. And what we hear instead from many of the companies that we engage with is the need to pursue what they call a China plus one strategy. So complementing their existing manufacturing capabilities in China with additional factories or supply chains elsewhere, be it Vietnam, India, Mexico, or the US. And so we think that this will potentially lead to shifting dynamics in regional supply chains. I think it's also important not to lose sight of the fact that China has a middle class of 400 million strong that are seeing improving income. So many companies want to have a presence that is close in proximity to China to be able to serve this rapidly growing end market.
Got it. Let's kind of go back to Russia a little bit more specifically. As a result of the invasion, Western civilizations have really been isolating them with a series of serious financial and economic sanctions. Global companies have been pulling out of Russia. They have been removed from emerging market indices. What are some of these longer term implications of these moves?
Well, I think the most notable of these impacts is likely to be the sanctions on Russia's central bank. For context, coming into the invasion, Russia held about $643 billion of foreign exchange reserves, and about 60% of that was denominated in G7 currencies. And across the board, the G7 economies moved to freeze these foreign exchange reserves. Now, taking a step back, countries tend to hold foreign exchange reserves for two reasons. The first is to defend their currencies against exogenous macroeconomic shocks. And the second is to act as a war chest for times like this. And effectively, Russia's war chest has been nullified, so to speak. So moving forward, I think this has meaningful ramifications for the way that countries may look at holding foreign exchange reserves. It could involve a diversification of these reserves into other currencies or into gold. It could also involve just simply holding fewer reserves as the war chest mentality dissipates. So this has a number, again, of second and third order implications, particularly as we see mounting U.S. Fiscal and current account deficits, and a Fed that seems like it no longer wants to expand its balance sheet, but maybe wants to shrink it, in fact. So if countries are generating fewer foreign exchange reserves and maybe having less demand for U.S. treasuries in that environment, it creates a host of different ramifications stemming from that.
Got it. We have a few minutes left, and so I think it's important to ask one of the questions that we hear the most. And you talked a lot about China and the implications for China, but the question we get a lot is, as it relates to the war, there are likely strong implications for how China handles Taiwan and the approach with Taiwan. Can you share your thoughts on this, and more importantly, how it impacts your investing, given that China accounts for approximately 1/3 of the emerging market index?
Yeah. So as background, we tend not to make big sweeping predictions about things that are inherently difficult to predict, such as geopolitics and certain aspects of macroeconomics. I certainly understand that there are a wide range of views out there as it relates to China and Taiwan. I would draw maybe a few contrasts between China and Russia in the current situation. I tend to think of Xi Jinping as a leader that has maybe a bit more pragmatism and longer-term orientation than Vladimir Putin. I do recognize that there may be historical or cultural or strategic reasons that China may want to bring Taiwan under its control at some point in the future. But I think that there may be some factors that also deter this, at least in the near to even intermediate term. One thing that we look at is just really China cares deeply about the evolution of its economy. And I think if we look 10 years ahead, we could be in a situation where China and the US are neck and neck in terms of vying to be the largest economy in the world. Certainly both of these countries are looking ahead to the development of next generation technologies, with an eye in particular on AI. And so we don't think it would really be in China's interest to move into something that's going to cause irreparable harm to its economy. I think also Xi Jinping really plays to domestic politics. And again, I recognize that 400 million middle class, there has been an extreme amount of emphasis on policies to bring about a better social dynamic in things like making education, healthcare, and housing more affordable for these people. So again, I think China in some ways has been a bit more inward focused in recent years. And then lastly, I think from a strategic standpoint, a couple of things to bear in mind. Number one, any sort of invasion we expect would be likely met with a greater US presence kind of on the ground than what we're seeing in Russia and Ukraine. And then lastly, from an energy standpoint, roughly 90% of China's oil imports come from the seaborne market, not from the pipelines from neighboring countries. So certainly concerns over the security of energy have been palpable even in recent years of peacetime, but particularly if one were to enter into an invasion, that could be another source of vulnerability. And then I guess the last point that I would make is we've obviously seen on display what the US and G7 can do in terms of the freezing of FX reserves. China has an order of magnitude larger FX reserves north of $3 trillion. So again, this would be a major economic hit that I think could dissuade China from any hostile actions toward Taiwan. So those are just a few kind of views. And again, our underweight in China over the past year, just to be clear, has been a reflection of earnings pressure and regulatory pressure on key areas of the market, rather than any sort of geopolitical views surrounding Taiwan.
Excellent. Thanks, Chad. I realize with all these topics, you could probably talk hours on each of these questions. So I really appreciate you making such concise comments in such a short period of time. So thank you very much for being with us today. I really appreciate it.
Thank you, David.
I'm going to welcome back my colleague, Bill, to close us out. Thanks.
Hi, everyone. Thank you to Jason, David, and Chad for the insightful conversation. A little bit of disclosures on there. The discussion that you just heard is for informational purposes only. Past performance is not indicative of future performance. And as you know, all investments are subject to risk of loss. If we get back to talking about Altair, the work that we do with clients is widely recognized in the industry. Cranes, Financial Times, Barron's, Forbes, Financial Advisor Magazine, Investment News are just some of the publications that have recognized the good work that we do for our clients over time. If you have any questions about what you've heard today or would like more information, feel free to contact me or your primary contact at Altair. You can also look at our website. We're also post on LinkedIn, Twitter, and Facebook if you'd like to follow us there as well. I just wanted to say, concluding the webinar by thanking you for attending. All the best to you and your families. Have a great day.